Hi, welcome. So, we were discussing about IFRS 9 and now we are going to discuss the classification, then recognition and measurement of IFRS 9. Okay, so first of all, you must know that this standard has been made very easy for you to understand it completely. Even for companies, even for everybody, the standard is now extremely easy. Okay, so why there is classification, then recognition, then measurement? So there's no need, right? You just have to understand what is the main reason for classification. You will understand directly how to recognize it, how to measure it. Okay, so as I told you previously also, initial measurement of a transaction is done on the actual transaction price, right? It is not, we are not talking about that. We are talking about the subsequent measurement. Now, what is the subsequent measurement? Subsequent measurement is measuring the asset on a balance sheet date, right? And why we are discussing the subsequent measurement? Because it will impact the profit and loss. So we have to decide previously only whether it is impacting profit and loss or whether it is impacting our other comprehensive income. It is simple. This is what we are discussing over here in IFRS 9. And what value of assets to be shown in balance sheet, so that the readers of financial statements, or you can say the investors, can get a clear picture from our financial statements, right? Okay, so what is the classification in IFRS 9 for financial assets and financial liabilities? So we'll talk about financial asset first. Okay, moreover, the classification is same, but there's some slight changes, slight differences we'll discuss. So what is the classification of financial asset? In a previous video we told you about the classification in IAS 39. There were 4 classifications, right? Number 1 was held to maturity, available for sale, held for trading, then loans and advances. So there were 4 classifications. Why there were 4 classifications? People couldn't understand it. Why there were 4 classifications? It was not clear in the standard itself why we are making 4 classification, which asset to classify under which. It was not very much clear. But in IFRS 9 they made it very simple and very clear that there would be 3 classification for financial asset, right? Number 1 is subsequent measurement at amortized cost. Number 2 is subsequent measurement at fair FVOCI, and number 3 is subsequent measurement at FVTPL, right? Why these 3 classifications? See, they made it very simple. They said just see the business model of the company, what the company wants to achieve. Okay, you just have to see the business model, then only you'll be able to understand which asset should be classified where, right? So the first classification which they gave was amortized cost, right? Now, what is this amortized cost method? See, there are some assets for which income was not being booked properly previously. For an example, if we talk about deep discount bonds, right? Do you know the accounting for the deep discount bonds? Previously, as per Indian accounting standards, what we used to do is, let us take an example. Let's say the company issued a deep discount bond for rupees, face value is 100, at issued at let's say 60 rupees. Okay, they issued at 60, and which will be redeemed obviously at 100. At 100 they'll redeem it. So what we'll do is, in case if there is no transaction cost, we'll book a deep discount bond debit. This is our asset at 60 to bank 60, right? Then this is for 5 years, right? Year 1 we do this. Year 5 what we do is bank debit 100 because we'll receive 100 rupees, to deep discount bond 60, and to income 40. This was being done previously because we were not accruing the income year wise, right? In deep discount bond in Indian accounting standards, I don't know about the US standards. In previous standard IS 39, it was there already. But why we are discussing this? We are discussing the origin of the standard. Okay, in IS 39, this was already available. Okay, now we talk about another example. Let's say debentures, redeemable at premium, right? So similarly, in this case also, we are booking interest income yearly, like year 1, year 2, year 3. We are booking interest income on all the 3 years, but premium we will book only in year 3, right? So this is creating a difference. What difference? That we are booking income in year 5, that is last year. We are booking premium income in last year. Is it so? I mean, is this income only related to last year? No. Since we have invested our money for all the 5 years, right? All the 5 years we have invested, year 1, 2, 3, 4, 5. We have invested our money for 5 years. So this income what we are getting is for all the 5 years. So this income should be distributed evenly over the 5 years time period, right? Which was not being done in the previous standards. Hence, this standard said that there should be an effective interest rate, at this rate the interest will be calculated and booked over all the 5 years, or you can say over the period of the asset, right? So you understood the concept of amortized cost. Amortized means evenly distributing the income over the life of the asset. This is amortized cost concept, right? So first classification they gave was subsequent measurement and amortized cost. We'll not talk about the subsequent measurement, I've told you earlier. So we'll talk about amortized cost, FEOC, FETPL. Okay. So under amortized cost method, they said you just check, you can say 2 models, right? For any classification, for classifying any asset, you have to check 2 models. Number 1, I'm just telling you the small concept, then we'll combine it. So number 1 is the business model concept, and number 2 is the cash flow model, right? Now what are these 2 models? They said very simply, if the company, the main business model of the company is to hold the asset, right, holding the asset and earning from the cash flows of the asset, just like debentures, that if a company is investing in a debenture to earn interest thereon, this is a clearly business model is to hold the asset, and the cash flow is cash flow tests are solely payment of principal and interest, which means the company solely want to earn from the principal, get back its principal and the interest payments, nothing else. This is the motive of the company. Suppose the company is investing in a debenture of another company, and the motive is behind to earn the interest income, nothing else. They do not want to hedge, they do not want to resell, do not want to do anything else. It's a simple investment. Then in that case, it should be that debenture should be classified under amortized cost method, and interest should not be booked as per the interest given by the debenture. Just like, let's say if the debenture is giving a 6% interest, it should not be booked like that. It should be booked according to the effective interest method. It's clear. This is clear. We'll take an example in let you go through. Let us just understand the concepts in this video first, okay? Then in the another video, next video, will take you through the examples. So this is the amortized cost concept. The main reason behind amortized cost concept is to book income evenly throughout the period or throughout the life of the asset. It is very simple, okay? And these two models, based upon these two models, you can judge whether the asset will be classified as amortized cost or FVOCI or FVTPL, right? Simple, clear, understood? As the name suggests, amortized cost method means evenly distributing, amortizing the income, right? This is simple. Now, what is FVOCI? What is FVOCI? FVOCI is fair value through other comprehensive income. Here they say if the business model of the company is to either to hold the asset or to sell it. I mean, the company doesn't know. It is very simple. They are saying that the company doesn't know whether they want to sell it, whether they want to keep it. They just bought the asset and they thought, okay, if I get the value, then I will sell it, otherwise I'll not. The company is not confirmed. Hence, in such a scenario, the profit should not impact your profit and loss, because this profit or income would be a casual income. Company's business model is not clear, right? So they said it's better to keep it in other comprehensive income and do not touch the profitability of the company. It is a clear concept. The company is not sure why they're investing and what income they want to get. They're not sure about the business model. Then this is not a part of your profit, regular income or operating profit. This is not part of your strategy. Hence, it should be classified as FVOCI, right? Now, number 3, FVTPL. Now, what is FVTPL? In case, okay, the cash flow model, I'm sorry. So there are two tests. First test we did was the business model test, wherein we have to see whether to hold the asset or to sell it. What is the main reason? If the company is not sure, then it would be FVOCI. Cash flow model test does not even apply over here, okay? If the company is not sure, the cash flow model is not applied. Then number 3 is basically equity derivative, FVTPL, sorry, FVTPL. Now, how to classify as FVTPL? If the company's main motive is to gain from the increase in value of an asset, then it should be classified as FVTPL. It is simple. There is no cash flow involved. The company's main motive is not to hold the asset and earn from the cash flows. The main motive is to earn from the increase in share price, increase in the price of the asset. It is then such an asset will be classified as FVTPL, because it is just like a buying and selling gain, which a company wants to do to earn the gain, or you can say it would be a you can say a strategy of the company to earn or increase their profits. Hence, it will directly impact the profitability of the company, right? This is the basic classification or basic understanding of the standard for financial asset. Here also, in third part also, business model is clear. The company want to sell it. Held for trading is company want to sell it anytime when they get the increase in price. Now, the cash flow is not applicable similarly, because their motive is not to earn from the cash flow. Now, we talk about the assets which are covered in these, right? If we talk about the amortized cost method, see, there are some assets, the basic nature of which is included in these classification. Like if we talk about debentures, the debentures prices does not vary a lot, so you cannot classify them as FVTPL, right? The standard doesn't you can say no exactly, but they say the nature of such asset is not such that it can be classified as a FVTPL. If we talk about debentures are clearly debentures, or you can say preference shares may be a different thing. If we talk about debentures, these are clearly classified as amortized cost, because the basic nature of debenture is to earn interest. Not even a single company will buy it to earn increase, because there is no increase in the prices. It is a fixed rate, or you can say fixed liability to the company paying interest, right? Hence, debentures will always be classified under amortized cost method. Now, if we talk about equity, the basic nature of equity is cannot be it cannot be to earn cash flows. Hence, the equity will always be classified whenever the company invests in an equity. It will always be classified under FVTPL. Nobody has to say that, but it is the basic nature of an equity. But equity can be classified under FVOCI, but not under amortized cost. Why? Because the basic nature doesn't allow. Basic nature of equity is wealth creation, right? There's no regular income in equity, so you cannot amortize the income of equity, right? Am I clear? But it can be classified under FVOCI, because in case the company invested in a share market of equity share of X company, and they want to earn, they're not sure whether they want to hold it or whether they want to sell it, then it can be classified as FVOCI, but not as amortized cost, right? Based upon the basic nature, right? So there's some basic nature of such asset which we discussed. Otherwise, you got a basic point that there are two tests based upon which the classification is done. Now it's very simple for you to understand, right? Now, what are the convertible bonds? If we talk about convertible bonds, these may be classified under FVOCI. We'll discuss it when we come to that topic of, or you can say we'll take an example of it, because it is just based upon the intention of the company. It may be classified as amortized cost also, right? So there's nothing sure, but two things are very sure: that equity will not be classified as amortized cost, debentures will not be classified as FVTPL, right? These two things are for sure. Rest is based upon these two tests. Okay, are we clear about that? I think we have understood everything in this slide, and we have understood the classification of asset based on the two models. Okay, so based upon this, now we have to understand it practically, how to you're thinking about how to calculate effective interest, and how to sorry, how to account for. But see, that's why I told you in the beginning, we're talking about classification. That accounting will come under recognition and measurement. So please keep hold on till then, because we will see that in recognition and measurement. We'll tell you start away from the beginning, all the entries when the asset is recognized initially, then at subsequent recognition, then for on sale, everything will tell you what are the disclosures. It's very simple. IFRS 9, they have made it very simple, so don't get don't take any tension. We'll discuss it. Okay, in the next lecture we'll talk about basically financial liabilities and their classification. Okay, till then, bye bye.